Hello everyone and welcome to today's video where we will be discussing the CA Final FR May 24 RTP. Now this RTP has been fairly manageable. The institute has given you a few case-based questions and then a few descriptive ones. Most of the descriptive questions are similar to the earlier institute material or the question bank that is covered. We will discuss in general, but keep emphasis on the few questions which are slightly different. Within the case-based questions also, there are around 10 questions. Most of these are manageable, and if you have done the MCQ material that we have even shared, almost all the questions out of, I think, 10, around 9 odd questions are directly similar. So that should also be manageable, but nevertheless, we will discuss this independently so you can kind of just go on to the place where you think you want some additional guidance. So let us get started. In your case scenario, generally in these cases, most of the sums that do come would involve 5 or 6 questions which are linked to different paragraphs. Now each paragraph is like a separate case altogether, so there's very limited interlinkage per se. So like here you have 3 points. These 3 points are completely independent of each other, and based on that you have a few questions. So you would go through the cases once. We will also go through it, but over here the first sub point is linked to point 1, the second sub point is linked to point 3 that you can see above, the third MCQ is linked to sub point 2, and then fourth and fifth is also linked to the sub point 1 only. So sub point 1 has 3 related MCQs and 2 of them are linked to the other part. So let us quickly review. FA is a company which is manufacturing aircraft parts and engines and sells them to large multinational companies like Boeing, Airbus, etc. And they have entered into following transactions. So that is a general description about FA. On 1st April 2022, the company began construction of a new production line in its aircraft manufacturing shed. Okay, so there's a production line, then the costs relating to the line are as follows. You have been given various costs, and then on the next page you have been told that the production line took 2 months to be ready for use and it was brought to use on 31st May. So the expenditures which are incurred during those 2 months are directly attributable to construction and hence should be capitalized. The other overheads were incurred during the 2-month period ended on 31st May. So overheads were during that 2 months period, and they included an abnormal cost of 0.3 lakhs caused by a major electrical fault. So this abnormal cost will not be a part of the cost of the overall line. And the line is expected to have a useful life of around 8 years. So you will depreciate over 8 years. However, in the current year, it becomes ready for use in May, and hence the depreciation will start from May, that is around 10 months during the year. After 8 years, FA is legally required to dismantle the plant in a specified manner and restore it to an acceptable standard. The amount of 2 lakhs included in the cost estimate is the amount that is expected to be incurred at the end of the useful life of the production line. So 2 lakhs is the expected cost for dismantling to be incurred at the end. The appropriate discount rate is 5% and the present value factor at the rate of 5% is approximately 0.68. So you will try to find the present value of site restoration obligation. So this is regarding the site restoration obligation. These are overheads and the abnormal loss, and this is the 2 months that are ready to get the asset in the ready to use condition. Then you've been told 4 years after being brought to use, the production line will require a major overhaul to ensure that it generates economic benefits into the second half of the life, that is for the next 4 years. The estimated cost of this overhaul at current price is 3 lakhs. Remember, this is a cost that will be incurred after 3 years, and as a result you will not separately capitalize it. However, this can be used for the purpose of component method of depreciation, because in your current cost there would be some part which will have to be written off over 4 years only, and the remaining part may be written off over 8 years. No impairment of the plant has occurred till 31st March 2023. Now there are a few other items. We can use this for the purpose of calculating our total cost, then finding the depreciation and everything else based on that. So we have kind of gone through the case in general. Cost of basic materials whose list price is 12.5 lakhs less 20% rate discount. Rate discount is to be deducted, and hence this 10 lakhs should be a part of the cost. Recoverable goods and services tax incurred but not included in the purchase cost. So this should not be included. Well, it is not included, and hence there is no separate adjustment to be done for the same. Employment cost for construction staff for the 3 months ended 30th June. Ideally, this should be for 2 months. If 1.2 is for 3 months, then for 2 months it will be how much? So let us say this will be 0.8. Sir, what about the remaining 0.4? It will be taken to the profit and loss account as, let us say, employee expenses. Other overheads directly relating to construction. So we have been told that out of this 0.3 is abnormal in nature, and hence 0.6 is what will be capitalized. The remaining 0.3 will go to the P&L. Payment to external advisors relating to the construction. If it is construction, it is directly attributable and hence should be added. And expected dismantling and restoration cost is 2. But this is 2 to be incurred after 8 years. And hence, if you were to take the present value, this is into the present value factor, which is given to you, I think, as 0.68. And hence, this is 2 into 0.68 comes to around 1.36. So if I were to take on 31st May, the initial cost for the PP, this would be 10 plus 0.8 plus 0.6 plus 0.5 and plus 1.36. So this is what, 10.8 plus, let us say, if I do this working, I think this is 13.26. So do I need to separately add the overall cost? Answer is no. The obligation arises after 4 years. However, if I were to find the depreciation, if I do the component method of depreciation, I would say that for the overhaul, let us say an expected cost is 3. For this 3, the life is 4 years, and for the remaining 10.26, the life is going to be, let us say, 8 years. And hence, the component method of depreciation would be 3 into 1 by 4 into 10 by 12, because in the current year there are just 10 months that should be considered. 10.26 again into 1 by 8, so the life over here will be 8 years for the remaining, and again into 10 by 12. So if I were to calculate the depreciation, this is 3 divided by 4 into 10 by 12 comes to, I think, 0.625 over here, and 10.26 divided by 8 into 10 by 12 comes to around 1.6875. Probably if I total both of these, this will come to, let us say, 1.69 something. That will be your depreciation, let us say. Okay, other than that, there will be a site restoration obligation. This site restoration obligation will be at 1.36. After that, there would be certain unwinding, and that unwinding would be 1.36 into whatever is the rate. I think this is 5% of the rate, and that is for a period of 10 months. So this will give you the annual unwinding we have to take for 10 months. This is 1.36 into 5% into, let us say, 10 by 12, and this comes to, let us say, 0.0567, let us say. And accordingly, this will be around 1.36 plus 0.0567 comes to around 1.4167, let us say. So considering that, we have kind of tried to take a few things. So let us see what the MCQs are. The first question says, which of the following need to be capitalized in determining the cost of the production line? Abnormal cost, no. Recoverable GST, no. Initial estimate of cost of dismantling and removing the item of 2 lakhs. Well, ideally, site restoration should be added, but not at 2 lakhs, but at present value. So point D says this should be included at 1.36, and hence the answer is D. Calculate, point 2 is to be done in some time. Then you will go to point 4. Compute the total amount to be charged to the statement of profit and loss. The question says, with respect to the production line for the year ended 31st March 20x3, and the balance of the provision for dismantling cost to be carried to the balance sheet. Now in this case, I would say that there is a certain degree of ambiguity and alternative treatment possible, but in MCQs you can't write a note for an alternative solution. So whatever is the nearest is what you should take, and based on what is most reasonable. So first of all, if you look at provision for site restoration, we have just calculated that provision to be around 1.4167. After considering the unwinding, 1.4167, if you go to see over here, that is around 1.42. that is the number in point C. Other than that, what goes to the profit and loss? So this is very clear. So my default answer should be C, but just to verify, what goes into the profit and loss account? Well, ideally in the profit and loss account, I would say depreciation will be taken. Other than then, unwinding would be taken. Now these two items, one can say, are directly attributable to the production line. They will be expense to the P&L, yes, but they are linked to production line. So the depreciation that you can see over here, that you must have calculated, just a second, your total depreciation is around 1.69. so that 1.69 or 1.7 as the case may be would be the depreciation, and your total unwinding, if I, let's say, take it up to 2 or 3 decimals, is 0.0567. so that is, let's say, 0.057, let us say. Now this can be said to be directly linked to the production line. So if I total this, 1.69 plus 0.057 comes to around 1.747 or 1.75 approximately. The closest to that number is 1.76, and hence this also makes sense. Now at this stage we have also received doubts from the students who kind of say that, sir, other than that, even the abnormal loss of 0.3 should go to the PNL. Even the labor cost of that 1 month of 0.3 should also further go to the PNL. Should they go to the PNL? Yes. Are they directly attributable to the production line? Well, probably no, and hence the ICAI has seemed to ignore these. And hence, looking at the options as well, there does not seem to be an expense head which takes this, and hence we will answer based on option C. Though if you take the total expense to be recorded in the PNL, even abnormal loss and labor cost should be taken to the PNL for that 1 month. But since it is not probably linked in respect of the production line, so institute seems to have taken only the depreciation and unwinding over here. Okay, so that is point 4. I would say this is slightly important. Compute the cost of the production line to be capitalized initially on 31st May. Well, that is very clearly calculated. That is around 13.26, and hence your answer is option A. So that takes care of these 3 MCQs. Next, you go to sub point 2. During the year ended 31st March 2023, FA provided consultancy services to a customer regarding the installation of a new production system relating to aircraft parts. So we have provided a consultancy. The systems caused the customer considerable problems, so the customer has taken legal action against the company for loss of profits that are arisen as a result of the problems in the system, and the customer has claimed damages of 1.6 lakhs. Now, these damages, if you accept, are a liability. If you are appealing, can be contingent, and if it is still pending litigation, then this could be something where you will have to look at contingency, where Ind AS 37 guidance on whether if it is probable, that is more than a 50% chance, you create a provision, otherwise you give a disclosure. The legal department of FA considers that there is a 25% chance that the claim can be successfully defended, which means there is a 75% chance that you will lose, and if you will lose, then you will have to pay. The legal department further stated that it is reasonably confident that the company is covered by insurance against these types of losses. Now that is a contingent asset. That too, if there is a loss arises, there is a contingent asset. That does not mean that you don't recognize the loss. You will still have to pay the loss because insurance is a separate contingent asset. The accountant feels nothing should be provided as the company is suitably covered under any possible losses. Is that contingent correct? My opinion is no. You will have to record a provision because there's a more than 50% chance that a payment will have to be made for, let us say, 1.6 million. And as a result, if I go to the MCQ number 3, what treatment should be done in FA's books for the year ended 31st March 2023 as a customer has taken legal action against the company on account of loss of profits? So on account of that customer taking action, nothing is to be provided. Well, that is wrong. You have to provide because that's a separate insurance. Provision of 1.6 should be recognized with a corresponding charge to the PNL. This seems to be correct. Provision of only 0.4 as per the best possible outcome should be recognized. Well, this is wrong. Well, 0.4 is just 25% of 1.6, which is not correct. And contingent liability would be disclosed in the final statement. Charge to profit and loss would be recognized when it is settled. No. As per Ind AS 37, you will recognize a provision which is probable, and hence 1.6 will be recorded. If there was a mention regarding contingent asset, maybe if you think it is probable, you can even mention regarding the contingent asset. But as of now, nothing of that sort needs to be separately asked, and hence we have not commented. Okay, next is calculate the company associates Flynet's cash flow from operations. If you go to see, that is exclusively linked to sub point 3. FA has an associate company, Flynet. The following are the information for Flynet for the year ended 31st March 2023. So net income after taxes. So this is finding what? You have to find cash flow from operations. Okay, CFO. So this is net income after taxes. Okay, decrease in accounts receivable. Remember, current assets opposite relation, current liability is direct relation. So if there's a decrease in accounts receivable, you will add. Depreciation non-cash in nature, you will add. Increase in inventory, subtract. Increase in accounts payable, add. Decrease in wages payable, current liability, subtract. These are operating items. And tax charge for the year, this is deferred tax liability. Now usually what do you do? Net profit after taxes plus you will add tax and then subtract what is paid. In this case, probably the 15 rupees is due to deferred tax liability, and hence you have not paid anything. So you will add back, for example, 15. It is non-cash in nature, but since it is not paid, you will not separately deduct it. If this was a current tax expense, you would have even separately subtracted it. So 15 is added back, 15 is deducted. No effect would be there. If this is current tax, this is deferred tax, and as a result, you will kind of add back. And profit from the sale of land. Remember, this is an investing item and should be reversed from the cash flow from operations. It must have been included in profits, and hence you will have to subtract it. And hence this is what, 120 plus 20 plus 25 minus 10 plus 7 minus 5 plus 15 minus 2. So answer should ideally be 170. Hopefully that is there. So this is your option B. So this kind of takes care of the first 5 MCQs. Next you go to case scenario 2. There are again around 4 odd points over here. If you go to see the first point over here, if you will see, this is connected to your MCQ 10. You can read this entirely. I'm just giving you a reference so that we are kind of aware. Point 9 is general. It is not connected to any specific case. Your point 8 is linked to sub point 2. Point 7 is linked to I think sub point 4, and your point 6 is linked to I think point 3. So these are the relevant cases that you should read before you actually come to these MCQs. Generally, even in the exam, you should glance through broadly the MCQs, not the options, just the MCQs, so you know which case pertains to what and optimize your time. Okay. At what amount shall HSL carry its investment in NM in its consolidated financial statements? So this is regarding sub point 3. If you go to see, HSL has acquired a 40% stake in NM, so that is an associate, as on 1st January 2022 for 8 lakhs and classified the investment in NM as an associate. Okay, just a second. If you go to see, HSL is a car manufacturing company and has entered into many transactions, so nothing notable is there over here. 40% on 1st January for 8 lakhs. So is that to be included? Well, yes, 8 lakhs is a part of initial. Associate is equity accounting, which means you will add your share in the profit, subtract any dividend, your share in the dividend received. On 1st January, the carrying amount and the fair value of the plant and machinery of NM is 3 lakhs and 5 lakhs. So there is a 2 lakh fair value adjustment, which will be used for the purpose of goodwill calculation. When you were to identify goodwill for an associate, for that you will take your 5 lakhs, which is the fair value of the net assets, into consideration. With the remaining useful life of 5 years, that is 20 quarters. Why are we mentioning quarter? Because year ending seems to be 31st March. So from 1st January, if you have to consider any depreciation, etc., 3 months have gone by, that is 1 quarter. From the 1st January 20x2 to 31st March 20x2, NM generated a profit of rupees 50,000. Now this is profit as per NM's individual books, and NM must have calculated the depreciation based on 3 lakh rupees. However, for the purpose of goodwill calculation in your associate, you must have taken the fair value of 5 lakhs, and hence depreciation on that additional 2 lakhs should also be calculated for 1 quarter. So over here we will say that we will add our share of the profits. So to this you will add, let us say, 50,000, which is the total profit, into 40%, that is our share, which will come to I think 20,000. You will add 20,000, but this 50,000 is calculated based on the depreciation of NM. Now if I were to calculate the additional depreciation over here would be on this 2 lakhs, the depreciation would be over the 20 quarters, out of which 1 quarter has gone by. So 2 lakhs divided by 20, and hence your depreciation is 10,000. However, what I will take is only 40% of that. So 10,000 into 40%, that comes to 4,000, and that will be subtracted. This is additional depreciation, and hence your answer should come to 8,16,000. So over here, if I go to C, your answer is 8,16,000, option C. Okay. Next is sub point 7. Here students do have some doubts regarding the treatment of cash discount, etc. Remember, the generally accepted accounting practice that is even used for items like PPE, etc. as per GAAP is trade discount should be deducted, whereas cash discount is taken against the profit and loss. However, when you look at Ind AS 115, that is revenue, 115 does not distinguish separately between a trade discount, cash discount, etc. 115 says that revenue should be recorded at an amount that an entity expects to receive. If an entity expects to receive less due to maybe a trade discount, maybe due to a cash discount, maybe due to some other item, some other variable consideration, or a voucher, or something else, we should consider that as well. And hence in point 7 there can be a possible error when you will solve. How should HSL account for the trade discount, cash discount and the voucher given to customers on the sale of a car? So if you look at sub point 4, while selling a car, HSL provides a trade discount of 1% on the sale price, which is mentioned on the invoice. So this is clearly something which we say is to be deducted. This is a 1% trade discount. As per gap also you deduct, and otherwise also this is something that you don't expect to receive and hence you deduct. HSL provides a credit period of 7 days to its customers. However, if paid upfront, then HSL gives an additional cash discount of 2%. Now, if it is paid upfront, there's an additional cash discount, and hence that is an amount that HSL does not expect to receive, and hence as per Ind AS 115, even this needs to be deducted from the selling price. As per gap, ideally we would have said that okay, 100 rupees minus 1% trade discount 99, and if there is any cash discount, whatever is the cash discount amount, you will take it to the P&L separately. No, not under 115. You could have done this under AS9, but under 115 you have to record revenue at an amount that the entity expects to receive, and if the entity expects to receive 2% less, then you will deduct that from your transaction price calculation as per 115. Remember that. HSL also provides a voucher worth 500 with a validity of 1 year, which can be used at an apparel store, which means this is an amount which is paid to the customer. Remember, there's a separate guidance under Ind AS 115. So if there's a consideration which is paid to the customer, in such cases, what do you do? Well, in such cases, we figure out whether against that is, are we getting any separate goods or services which are distinct, which does not appear to be the case, and if that is the case, you will have to deduct it from the transaction price. And as a result, when you look at subpoint MCQ 7, how should you account for the trade discount? Well, deduct, cash discount, deduct, and voucher. Against that, there is no separate distinct goods or services that the customer is providing, and hence even this should be deducted. So if you go to see option D, trade discount, cash discount and the value of voucher shall be reduced from the revenue. It is also an important question over here. Okay, next you go to point 8. This is linked to the second subpart. During the year, HSL issued compulsorily convertible debentures on a private placement for rupees 100 lakhs CCD, for private placement for 100 lakhs. Each CCD is convertible into 5 shares. Ajay, remember your issue price is 100 lakhs. Okay, each CCD is convertible into 5 shares at the end of 4 years from the date of issue at an annual interest rate is equivalent to 6%. The initial recognition recognizes a liability component at 20,79,063. So that is given, which means the remaining 100 lakhs, that is 1 crore minus 20,79,063. This will be 79,20,937 of equity components. So if you go to see, the equity component will be 79,20,937. Okay, HSL also incurs expenses of 2 lakhs in connection with the issue of the instrument. Achha, these are issue expenses. The nature of expenses include fees paid to legal advisors, registration, regulatory fee. What do you do? Well, we need to deduct these issue expenses, but from what? Well, from the liability component as well as the equity component. In what ratio? Well, in the ratio of the values had there been no transaction cost. So, your liability component is 20 lakhs. Your equity component is around 79.2 lakhs, and hence this transaction cost of 2 lakhs has to be split between the liability and the equity component in this particular ratio. So if you go to see over here, let us say you will have 2 lakhs into 20.79, whatever that number is, 20,79,063 upon 1 crore. This will be attributable to the liability component and you will deduct it. The remaining will be attributable to the equity component. So this is 2 lakhs. You can even take this as a balancing figure into 79,20,937 upon 1 crore. And hence this will be what? 2 lakhs into, let us say, around 41,581, and this is 2 lakhs into 158,419. Now where will this be going? This will be deducted from the equity component. This will be deducted from the liability component. Acha, equity component, there will be no further adjustment, but for the liability component, your effective interest will accordingly change, and hence your EIR will be slightly higher, and hence this will ultimately be expensed to the P&L in the form of a higher EIR. So if you go to see point 8, what shall be the accounting treatment of the directly attributable expenses of 2 lakhs incurred in connection with the CCD? The entire 2 lakhs shall be recognized as expense in the statement of P&L. Incorrect. Remember, the liability component is accounted for as a financial liability measured at amortized cost, and hence you will deduct from the transaction cost from the financial liability. Equity component will be a fresh issue of shares, and hence you will deduct the share attributable from the equity. Entire portion of 2 lakhs shall be reduced from equity, which is also wrong. A proportion of 158,419 should be reduced from equity, and the balance 41 shall be recognized as interest cost over a period of 4 years using effective interest. Now, a student generally is a little confused over here. They said, sir, 41,000 should be reduced from the liability component. They are not mentioning that. Yes, it is ultimately reduced from the liability component, but the way EIR works, that balance will be recorded. The transaction cost is actually recorded in the form of a higher effective rate, and hence point C appears to be the right answer. We'll just verify and see point D as well. Entire 2 lakhs shall be recognized as interest. Well, that is clearly wrong. Okay, then you have point 9, which is a general point. This is linked to Ind AS 27, which says that in the separate financial statements, you can show investments in subsidiaries, associates and joint ventures at cost or as per 109 principles. What method should you use? Well, this method is available for a category of investment. So it is possible that investment in subsidiaries you decide to show at cost. However, investment in joint ventures you can record at FATPL, for example. But within that, let's say if I have 3 joint ventures, each of them have to be recorded in a similar way. But that does not mean that the subsidiary also has to be accounted for in a similar way. Subsidiary is a separate category and hence can be accounted separately. So that is a base of this 9th point. With more acquisitions at the end of the year, HSL has investment in 2 subsidiaries, 3 associates and 1 joint venture. Which of the following statements is correct in relation to the accounting for these investments in SFS? HSL required to measure all investments in cost. Not necessary, you can even use 109. HSL is an option to account for these investments in associates, joint ventures using the equity method and carrying amount in subsidiaries at cost. No, in my CFS, I can show them at equity method. In the SFS, there is no choice for equity method. HSL is an option for each of these investments to be measured either at cost or in accordance with 109. Acha, that option is available, but that is not for each investment. That is available for a category of investment. So if you see point C and D, HSL is an option to measure all such investments either at cost or in accordance with 109. The option is available for each category of investment separately, that is subsidiaries, associates and joint ventures. This is the appropriate answer. It is not available for each investment individually. It is available for each category, and hence point D is the right answer. And last is point 10, where what you have to check is in respect of share purchase agreement. We'll see entered by HSL. Determine the date when HSL gained control over FM. When did HSL gain control? So if you see point 1, with the intention to expand, HSL has entered into a share purchase agreement with the shareholders of FM to purchase 30% stake in FM at 1st June 20x2. So this is a 30% stake. Now, does 30% give you control? Generally, no. At the rate of rupees 30, as per the terms of the SPA, HSL has an option to purchase an additional 25% stake in FM on or before 15th June. So does it have an option? Well, yes. So should that 25% be included in the assessment of control? Well, it depends. If the 20% is substantive, that is, I have the practical ability which gives me existing rights to direct relevant activities, do I have the practical ability to exercise? Well, we'll see that at a price of 30. Achha, you have already bought the current 30% stake at rupees 30 and hence the price of 30 seems to be reasonable. Similarly, the selling shareholder has also an option to sell the additional 25% stake on or before 15 June at a price of rupees 30. So basically, you have an option to buy, they have the option to sell, and that is at the fair market price, and hence 25% there seems to be a practical ability to exercise. And hence, even if I don't own the 55% stake as of today, I do have the substantive rights which give me the current ability. And as a result, over here, ideally there should be control with effect from 1st of June. You don't need to wait till 15th of June when the actual exercise happens. The decisions on relevant activities are to be made in the AGM or EGM. A resolution for AGM or EGM to be passed needs 50% votes, and they can be done by giving at least a 21 days notice to all the shareholders. So if any new decision has to be passed, it is at least 21 days away. Okay, so this 25%, which gives me substantive rights, will give me the current ability to direct activities probably from 1st of June itself, and hence your answer should be sub point A, that is 1st of June. I don't really need to wait till 15th of June to say that I can direct the relevant activities from then. From now itself, I have the rights which are substantive in nature, which give me the ability to direct, and hence this should be taken into consideration. So this takes care of the MCQ part of your RTP. Most of the MCQs are repeated. I would say, I think this point 10 was not there in your MCQ book, but other than that, most of the other MCQs you would see similar or exactly same MCQs in your book as well. Okay, we'll go to the descriptive section now. So now we'll go to the descriptive section. Business combinations, question 11, very similar to the study material question, even I think question 72 or so of our book, and it's also come in the past in the exam. So there are multiple ways of which we are solving this. In this case, there is an investment in an associate. You record this investment using the equity method, and then you acquire control. So this is a step up acquisition question. I'll quickly discuss this. So Pride acquired on 1st April 21 30% of the shares of Famous for 4,000 crores. Pride accounts for this investment using the equity method. That's absolutely right. On 31st March, Pride recognizes the net assets of Famous using the equity method as follows. So you will have, on the initial 4,000 crores, you must have passed the entry investment account debit to consolidated profit and loss, investment account debit to, let's say, FCTR in OCI, investment account debit to revaluation, and hence if you total this comes to around 4,425 crores. So the carrying amount is 4,425, and on 1st April 2022, Pride acquired the remaining 70% of this other company for 12,500. So with this, control is acquired on 1st of April 2022. The following additional information is relevant. For the fair value of the existing 30% stake is now 4,500. So basically it was 4,425. So there is a 75 rupees gain on remeasurement, which will be taken to the P&L because the existing stake has to be remeasured at fair value. The fair value of the net assets are 15,000 crores. You will take that over. You are required to determine the acquisition date. This is 1st April 22, for example, 20x2 as they have written. Determine the gain on previously held interest in Pride. So this is around 75, 4,500 minus 4,425, and says the accounting treatment on the acquisition date as per Ind AS 103. So you will take over the net assets. Let's say the net assets are taken over at 15 crores. 100% stake is acquired, so there is no NCI. Against that, you have made a payment today for the 70% stake at 12.5, and you have an investment which you have remeasured, which comes to, let us say, 4.5. And as a result, if you look at the balancing figure over here, the balancing figure I think comes to rupees 2, which will be, let us say, the goodwill. Compute the amount of goodwill arising on acquisition, PC plus NCI. So your PC over here is 12.5 plus around 4.5, that is equal to 17, minus net assets, there is no NCI, and hence the goodwill comes to 2. Pass the necessary journal entries on the acquisition date. So ideally this should be it. The institute has probably passed a single entry. In my opinion, there will be around 2 or 3 separate entries. So as to give a complete picture, first you will have to find the gain on remeasurement. So your investment account will be debited, let us say, by 75. I just put it in short, fair value gain at 75. Then you will pass the second entry where you will take over the assets and liabilities. But remember, once you take over the assets and liabilities, what happens to the balance in the OCI? Where there is some balance in the OCI, it will be transferred to either the retained earnings, or it will be transferred to the profit and loss, depending on whether there is reclassifiable or non-reclassifiable. FCTR is a part of the reclassifiable OCI, and hence the balance goes to the PNL, whereas revaluation is a part of non-reclassifiable OCI, and hence the balance goes to retained earnings. So apart from this, you will pass an entry separately, or you can pass the entry the way institute has done as a single entry. That is, you will have FCTR account debit, which is 50, to the consolidated profit and loss, which is 50, and you'll have revaluation reserve account debit, let us say 25, to the consolidated retained earnings, which is 25, and that is about it. Institute has clubbed it and passed this as a single entry, but that does not mean that the other workings are wrong. You can follow other workings as long as you're giving the same ultimate conclusion. Now the next question is a relatively new question, so I would say that you read this, not that it is very important, it is understandable. It is a typical question on ethics, where we typically divide the case into 3 or 4 parts. First, in the solution, we explain the appropriate accounting treatment that should have been done. Second, we explain the ethical considerations that has to be considered, and what are the principles that you need to use. Third is we suggest the appropriate action that should be taken. And lastly, the penal consequences if appropriate action is not taken. So a standard way in which you can kind of break down a 4 or 6 mark ethic question in your main exam. So over here, Astra is a listed company which operates in the defense and fiber sector. It supplies fiber optic cables and racks to domestic country. This activity is only a trading activity as it procures goods from pre-approved suppliers and after inspection sells the goods to IT companies. Pura time pass, bakwas. It does not really have any connection with the main ultimate thing in the question. Just general understanding. The sale contract requires Astra to deliver these goods to the IT company's locations. That is, delivery has to be given on site. That is when control is transferred, and as per 115, that is when the revenue should be recognized. Payment terms are 30 days after the invoice date. That's fine. Miss Suparna Dasgupta, a chartered accountant, has recently joined Astra as a head of finance. The COO, also the executive director, is Miss Padma Srinivasan, a mechanical engineer with MBA from Harvard. Not bad. Who rose through the ranks through her excellent project management skills, marketing and customer management. Well, that's just generic. Her remuneration includes a bonus computed as a percentage of turnover achieved during the year and an additional incentive for achieving an EBITDA in excess of 15% of the turnover. So she has, the CEO has a bonus which is linked to the revenue that is earned. Astra has sold fiber optic cables amounting to 2 crore. The invoice is dated 31st March. Okay, so as per Ind AS 115, when should revenue be recognized? Should it be recognized necessarily on the invoice date? No, that may be used for GST, etc. for example, but for Ind AS 115, revenue should be recognized when the control of the goods are transferred. In this case, when the delivery happens at the customer site. To Ethernet Bullet, a company providing high-speed internet connectivity services through fiber optic cables as well as dedicated lease lines. Okay, to some company. The service unit of Ethernet Bullet is located next to the factory of Astra. Though the goods were not moved, though the goods were not moved to Ethernet's service unit, Astra recognized the sale for the year based on the contention the service unit is adjacent and the transport can happen in few minutes. So be it. Has it happened? The answer is no. So till that time, revenue cannot be recognized. So the appropriate accounting treatment should be as per Ind AS 115. There should be no revenue to be recognized in this case. The annual results are due for board approval for the year ending 31st March and require sign-off of Ms. Dasgupta. Ms. Dasgupta has been given a 40% increment in joining Astra, which enables her to comfortably pay off her housing loan each month. Additionally, she is also given perquisites in the form of business class travel, exclusive chauffeur-driven car. Kya baat hai, will become CA and will get all of these benefits, stock options of the company. Accordingly, she has stated that she cannot afford to lose his job as the salary and perks are among the best in the country. Now, this poses kind of a conflict of interest, considerations, a dilemma on Ms. Dasgupta. Ms. Srinivasan has communicated to Ms. Dasgupta that many more benefits will accrue if she agrees to present the numbers without any modifications. That is, keep showing the 2 crores as a revenue. She has also said that the company would not hesitate to replace Ms. Dasgupta should she disagree with the contentions. So this is kind of a threat which is also there, which is looming on Ms. Dasgupta's head. So what should happen? You are required to discuss the potential conflicts. So the conflict over here is a conflict which Ms. Dasgupta, who is a CA, would have vis-a-vis following the appropriate accounting treatment, that is not recognizing revenue, and having the pressure of the management to kind of show this as a revenue, clubbed with the fact that there is a possibility that she might lose her job, her entitlements, and hence she might be under a personal problem. So there are conflicts over here. So you will first explain what the accounting treatment should be. We should say that this 2 crore should not be recognized as revenue as per Ind AS 115. Then you will explain these conflicts, the ethical considerations, and third, you will give the appropriate accounting treatment. You will come out in shining armor and you will always say that you will go on with the correct accounting treatment. Your ethical considerations rank above everything else. And hence, at least from an exam perspective, and even if possible in practice, what you should always do is you should follow the appropriate accounting treatment over here. And even if there is some pressure from the management, you should try to convince them that this is in the best interest of the investors, the readers of the financial statements, to present financials which are in the correct shape. What if you do not do this? Well, as per the part 2, I think, of schedule 2 of the second schedule, if you do not comply this, you will be subjected to gross negligence, and as a result there can be penal consequences will follow. So there will be these 4 things. In the above scenario, the ethical principles that would guide Ms. Dasgupta in responding to the situation. So you can just refer the solution. So basically, the first part, 115 says revenue should not be recognized. Second part, ethical considerations and conflicts that you should keep in mind, your integrity, etc. And then third, the appropriate action that you should ideally take. And fourth, the penal consequences under the second schedule if you do not take this appropriate action. So this is regarding ethics. It's a relatively new topic and hence it will kind of possibly come in the exam. Between technology and ethics, we do expect more possibility of an ethics driven question because there's an accounting element angle involved. At the same time, there is some auditing where we study ethics, etc. So there are a lot of angles involved. So ethics would most likely come in your exam. So that is important. Okay, next question 13. This is a fairly important question. It's a very interesting one. However, a much more detailed, a much more comprehensive and a much more interesting question we have already solved. It is one of the new sums which were added in the May 24 study material, and we have also put a separate video if you see on Ind AS 12 new questions added, where a much more detailed version of this question including the current tax and a lot of other things are there, so you can refer that. Otherwise, so I'll just try to share the link for the same above if possible, but otherwise you can just refer that, and if not, at least if you want to cover the RTP question, we will just review this quickly. So Joy wishes to calculate the tax base of the assets as on 31st March 2025. The balance sheet has been adjusted by current tax expense. In the study material question, you are also asked to solve for the current tax. So there's a much more complex angle over there, and more so for cases like IBS. So when you look at IBS, you have a multidisciplinary case study where you have income tax angle, you have financial reporting angle. So for something like IBS as well, this is something, at least the sums that we have solved are quite important. So you can just refer that please if possible. Summarize balance sheet irrespective. This is an interesting question, so we will discuss this. So over here you want to calculate tax base. You have been given a balance sheet and a plethora of adjustments, a lot of them. The question keeps on going till the end. What is asked? Calculate the temporary differences and deferred tax for Joy as on 31st March 25, assuming the tax rate is 32%. So what do we need to do? Over here you have the balance sheet. Now balance sheet is as per Ind AS, and hence this will represent the carrying value. This is the carrying value as per Ind AS. After that, next to this, to the extent required, we will calculate the tax base. Difference, if any, will either be deductible or taxable temporary difference, and on that we will calculate the deferred tax. So let us see one by one. Point A, depreciation expense for the year 24-25 allowable in accordance with tax laws is 2,06,000. This is as per tax. Accounting depreciation in operating cost is 1,70,000. The cost of PP is 16 lakhs, and Joy has deducted expense of 4,16,000 in its tax returns prior to the year. Okay, so if I look at the tax base over here, I will say that 16 lakhs is the total cost of the asset, out of which prior to this year there would be 4,16,000 which has already been deducted, and in the current year another 2,06,000 is deducted. This is as per the income tax records. Moreover, on 31st March 25, Joy for the first time revalued its PP to a fair value of 12 lakhs. A revaluation surplus is given. Remember, income tax does not give such revaluations, and hence as per income tax this is 16 minus 4,16,000 minus 2,06,000, and hence this comes to around 9,78,000. So if I were to calculate your tax base for the PP, this will be 9,78,000, and for the purpose of difference, the difference over here will be around 2.22. This you will call as, okay, this is a case if you go to see where your carrying value is greater than the tax base for an underlying asset, in which case the answer is opposite, which creates a deferred tax liability. So for this there would be a deferred tax impact. So when we calculate a deferred tax impact, there will be a DTL which is 2.22 lakhs, 2,22,000 into 32%. This was a taxable temporary difference, let's say TTD, taxable temporary difference. Carrying value is greater than tax base, so that will give you deduction of only 9,78,000 in the future years under income tax, and a deduction of 12 lakhs under books. So in income tax you will get a lesser deduction, and hence you will have to pay more tax. This is a fundamental, but otherwise this will give you a 71,040 DTL. Point A. Point B, in the year 11-12, Joy incurred product development costs. This is 11-12, I think 4-5 years back, of 1 lakh. These costs were recognized as an asset which is being amortized over the period of 10 years. For tax purposes, Joy deducted the full development cost in the year 11, 12, which means maybe in your books you'll have an intangible product development cost which is appearing at 60 after 4 years of amortization, but tax base is 0. Why? Because in income tax you must have pass the entry development expenses account debit to bank, P&L account debit development expenses. There is the entire 60,000 will be a taxable temporary difference, and because the carrying value is greater than the tax base, so 60,000 into 32% and you will get 19,200, again a DTL to the extent of 19,200. Point C, trading investments were acquired in 13-14 with a cost of 2,30,000. These investments are classified as FVTPL and recognized at fair value. Fair value adjustments are not tax deductible. So there's unrealized gains are not tax deductible, but when you sell it, probably that will have a tax impact. And as a result, when you look at your books of accounts, trade investments, a subsidiary, there does not appear to be any difference. So there will be no difference, so no deferred tax impact over here. As per income tax, you're showing this as 2,30,000. In the books, you have probably shown a 22,000 loss. In income tax, that will be recorded as in when you actually sell it, and as a result, there will be a difference of around 22,000. Now, this 22,000 is a deductible temporary difference because this will give you future deductions under income tax in the future. So, on this 22,000, there will actually be a DTA. So, this is 22,000 into 32%, and we get 7,040, which is a DTA. Okay, the next adjustment is a very important one on bad debt provision amounting to 1,30,000 relating to two debtors. Achha, so in the balance sheet, when you see the debtor 6,26,000, this would be after bad debt provision or before? So this would be after bad debt provision in your books of accounts. The net debtors would be appearing 626, and this is after 1,30,000, which relates to a debtor A 80,000 and a debtor B 50,000. So 80 and 50, that is going to be equal to 1,30,000. Okay. Tax law allows a deduction of 20% for the provision of debtors overdue for more than 1 year and 30% for debtors which are overdue for more than 2 years, and the remaining 50% for debtors which are overdue for more than 3 years. So this is for income tax. Now if I look at the tax base over here, this should be interesting. If you look at your trade receivables in your books are appearing at 626. This is after a provision for bad debt. We say whatever is in the books, we don't care. We have to find the debtor value after deducting provision for bad debts as per income tax. So over here, this would be probably 7,56,000. This will be your gross debtors before any provision for bad debts. Now when you look at debtor A, in books you have recorded entire 80,000 as bad debt. However, as per income tax law, what is the bad debt to be recorded? Well, receivable originated in the year 12-13 and 100% provision was recognized. That is in the books, but this originated in the year 12-13, which means the first year would be the year 13-14 and the second year would be the year 14-15 or 24-25, whatever it is. So over here, we don't know which date these debtors originated, but they would be originated during the year. Let us say, for simplicity, somewhere in the middle of the year. So let us say by 30th September 2012, the 1 year will get over on 30th September 2013, 2 years will get over on 30th September 2014, but 3 years will then get over on 30th September 2015, which is after the balance sheet date. In fact, any other date that you take, even 2nd April, 3rd April, 4th April, any date you take, you will see that these debtors as on 31st March 2015 are overdue for more than 2 years but less than 3 years. So over here, when you look at debtor A, on account of the debtor A, these have been overdue for more than 2 years. 2012-13, so more than 2 years but less than 3 years, and hence till now 20% plus another 30%, that is 50% of provision must have been created on a total debtor base of 80, and hence the provision over here must have been 40,000 as per income tax. Okay, that is for debtor A. When you go to debtor B, 50,000, which is a receivable originated in 13-14. Again, we don't know which date. Let us say at the middle of the year, 30th September 13, which means it is 1 year gets over on 30th September 14, and then these remain overdue for more than 1 year, but till 31st March 15, they are overdue for less than 2 years. So this is overdue for more than 2 years, however less than 3 years. This is overdue for more than 1 year but less than 2 years, in which case the provision is only 20%. So over here, this is 20% directly of 50,000, and as a result, this is going to come to 10,000. And if I take this, then in your ledger, you will have 7,56,000. As per income tax, 40,000 deducted. As per income tax, 10,000 deducted, and hence this should ideally be 7,06,000. So tax base as per income tax law, if I were to open the tax balance sheet, I will see probably 7,06,000. In the books, this is around 6,26,000, and hence there is a difference of around 80,000. Now this is a difference which is what we call as a deductible temporary difference. This is because carrying value is less than the tax base, and hence over here in income tax you will get deduction, more deduction worth 80,000 in the future years. This is a deductible temporary difference which will again give rise to a deferred tax asset of 25,600 deferred tax asset pertaining to this point. Point E, Joy accounts for the inventory obsolescence provision. New provision created during the year 14-15 was 10,800 and total provision till date, balance sheet is till date, is 18,000. The provision is not tax deductible as it is a general provision. However, when the inventory is actually sold, there would be a possible loss and income tax will record a loss then. So for example, it was a 100 rupee inventory which is obsolete and hence you are recording at 82. In the books you have already recorded 18, but in income tax when it actually gets sold at 82, there will be an 18 rupee loss and hence this difference is temporary. So now if you look at your income tax books, your income tax would say that, well, in the books this inventory is after recording this obsolescence provision 304 plus 18,000, and hence this is what I think 3,22,000 will be the inventory as per income tax, because in income tax you would not have deducted this, in books it must have already been deducted, and hence there would be a difference of, let us say, 18,000. Now this is a difference where income tax will give you a deduction in the future year. Carrying value is less than the tax base of an asset, which means the answer is in the same direction. You get a deferred tax asset, that is a deductible temporary difference. The logic over here is for 18,000 you will get a deduction in the future years as compared to in the books where deduction is obtained. So this will give you deduction in the future as a deductible temporary difference, which creates a DTA. This is 18,000 into 32%, again this is 5,760. Okay, next you have government grants are not taxable. They are not taxable in the first place. Government grant received in the year 14-15 is appearing in the balance sheet. So if you open the balance sheet, probably deferred income for government grants is 40,000, tax base is 0, so technically there is a 40,000 difference. However, since it is told that the government grant is not taxable, this difference is not temporary, it is other than temporary, and as a result there will be no deferred tax consequence pertaining to this. Okay, then you have in the year 14-15 Joy made a further provision of product warranty cost of 5,000, further provision. Such provisions for product warranty cost are not tax deductible until the claims are actually paid. During the year 14-15, warranty claims were paid or settled of 6,200. If they have already been paid, they must have been reduced already from the provision. So maybe your opening provision, for example, was 10,000. During the year, you made a further provision of another 5,000, becomes 15, and you paid 6,200, and hence your closing will probably come to 8,800. So whatever that is, your balance sheet will have provision for product warranty. This is calculated after all adjustments, and as a result this is appearing in your books under income tax. Yes, when you pay these, your entry, so income tax there is no provision. When you pay this, your entry will be directly P&L account debit to bank, and hence in the income tax balance sheet if you open, there is no separate provision appearing, so your tax base will be 0. But is there a difference? Well, yes, 16. For this 16, books has already recorded P&L account debit to provision. Income tax will record it as a deduction when this 16 is ultimately paid, and hence this difference is temporary. This is for something which is a liability where carrying value is greater than the tax base. Answer is in the opposite direction, so this is a deferred tax asset. Logically this will be a deductible temporary difference because income tax will give you deduction of this 16,000 in the future years, and hence this is a deductible temporary difference. Deductible temporary difference of 16,000, and 16,000 into 32%, this comes to I think 5,120. This is, let us say, a DTA. Okay, and next the last part. During the year 14-15, Joy has introduced healthcare benefits for employees. The expenses are allowed as a deduction in tax only when the benefits are paid, but in line with Ind AS 19, such liability is recognized in P&L when the employee provides the service. So over here you have a healthcare benefit. As per income tax, nothing is recorded in the tax balance sheet, so 0. But income tax will give you deduction when you actually pay it. So this is 70,000 of deduction, which is a deductible temporary difference, and hence 70,000 into 30%, or sorry 32%, will come to 22,400. This is 22,400, which is a deferred tax asset, and hence that takes care of everything. So if I were to calculate the deferred tax, your DTL total is 71,040, 19,200, that is your DTL. So this is I think 90,240 on your DTL, and when you look at DT, everything else 7040, 25,600, 5760, 5120, and 22,400. So DTA probably comes to around 65,920. And if I take the difference between the two, the net impact appearing in the balance sheet should ideally be around 24,320. It's a fairly complicated question, so I will just try to verify whether I have done this correctly or not. Question number 13. If you go to see ultimate effect, yes, 24,320. Net deferred tax liability, asset is 65,000, liability is 90,240. Again, a much more detailed and a comprehensive question, specifically important from an IBS standpoint, because there's a lot of income tax working as well, which is there in the study material, has been solved, and a separate YouTube video we have put for the same as well. So just try to revise this also if possible. Okay, so that takes care of 13. I would put 13 as important. Next, you have question number 14. So this is regarding commencement, suspension and cessation of borrowing cost. More of a case-based problem. So when we look at commencement of capitalization, you will commence capitalization once it is a letter of the date when loan is taken, activities commence and expenditure is incurred. Cessation happens when substantially all activities which are necessary to get the asset in the ready to use condition are completed. Minor administrative tasks which are still ongoing can be ignored, but they have to be minor administrative in nature. And suspension can happen if if there is, let us say, active development on the project which is interrupted for factors which are not necessary to get the asset in the ready to use condition, and this interruption goes on for an extended period of time. So keeping that into consideration, we'll go to question number 14. Slightly interesting case, I would say. PQR is engaged in the tourism business in India. The company has planned to construct a holiday resort, a qualifying asset in Shimla. The cost of the project has been met out of borrowed funds of 100 lakhs at the rate of 12%. Okay. 40 lakhs were disbursed on 1st April. So this is met out of this. So this appears to be a specific borrowing, case of a specific borrowing. You have been told that 40 lakhs were disbursed on 1st April 2012 and balance 60 lakhs were disbursed on 1st June 2012. The site planning work commenced on 1st June. Okay, so this is a date when work commences. You must have taken the borrowing on 1st April, but unless the work commences, you cannot start capitalization. Since the chief engineer on the project was on medical leave, the company commenced physical construction on 1st July. That's fine. Activities start, in my opinion, from 1st of June. So that's fine. Physical construction can start later. And the work of construction continued till 30th of September. Okay. And thereafter the construction stopped due to a landslide on the road which leads to the construction site. The road blockages have been cleared by the government machinery by 31st December. So the work was interrupted from 30th September to 31st December. So that is a good 3 months of interruption. Construction activities have resumed on 1st of January and has been completed on 28th of February. Okay, so they were completed on 20th February. So that is resumption of capitalization. The date of opening has been scheduled for 1st March. But unfortunately, the district administration gave permission for opening only on 16th March due to lack of safety measures like fire extinguishers which had not been installed by them. Okay. Determine the amount of borrowing cost to be capitalized towards the construction of the resort when first, landslide is not common in Shimla, so that is abnormal, and delay in approval from the district administration is a minor administrative work left over. So commencement will start from the date when loan is taken, that is 1st April, or expenditure incurred, or activities commence. Later of them seems to be, commencement date seems to be 1st of June. Later, when will it be cessation? When will you cease capitalization? When substantially all activities to get the asset in the ready to use condition are completed. So it seems that this is completed by 20th of February. However, what has been told is there is some minor administrative work which is left over. So if there is a minor administrative work which is left over, that minor work should not affect and hence your cessation will be done from 20th of February, for example, in this case. However, in the middle, suspension, is the active development interrupted? Well, yes, it is interrupted for 3 months from 30th September to 31st December. Now, this seems to be an extended period of interruption considering a 8, 9, 10 year month of life. 3 months is interruption, which is an extended period of time. and it is given that this is not due to factors which are normal in Shimla, and hence this is due to abnormal factors, and hence the capitalization will happen from 1st of June to 30th of September. Just a second. And it will then happen from 1st of January to 20th of February. So a total of 4 months over here and a total of 2 months over here. That is a total period of 6 months. Acha, so your actual borrowing cost during this 6 months. So this is probably by this time, by June, the entire 60 lakhs were also disbursed, and hence your borrowing cost to be capitalized would be based on the entire 100 into, let us say, what is the rate of interest? I think this is given to you as 12% into 6 by 12. And hence this is 12 into 6 by 12. So this is 6. The amount of 6 should be ideally capitalized. The remaining amount, whatever is the actual interest, you will sit and calculate. The remaining will be expensed to the profit and loss. The landslide is common in the second case in Shimla. So that interruption is due to a normal factor. And the approval from district administrative office is a major work left over. It is not a minor work. In which case, this is the first case. If you go to the second case, your commencement is still 1st of June. Should there be suspension? There would be no suspension over here because the interruption is there, but that is due to a normal factor, and hence there will be no interruption. And cessation over here will continue till 15th March. No sir, the asset is ready. However, major work is still remaining, and hence this will be till 15th of March. So if I go to see the entire period starting from June, so 7 months in the first year and around 2.5 months, so that is around 9.5 months. So over here this will be 100 into 12% into 9.5 divided by 12, and hence this will be ideally giving you 9.5. So if you look at the solution for this, over here we will have around 9.5, and in the first case around 6 lakhs. So this is question number 14. Next we go to question number 15, which is on financial instruments, in which case there is some possible impairment of financial asset. So we'll see what is to be done. The company has made a sales of 60 lakhs to a customer SSLLP on 31st December. So we must have passed the entry trade receivables account debit to sales at 60 lakhs. The normal credit period is 1 month. However, sometimes it goes up to 2 months. The company expects to receive the payment by 20th of February. That is within the normal credit period. And hence, you would have recorded these debtors at 60 lakhs. However, no payment has been received till 31st March. Okay. So this payment is overdue for 30 days. So this shows a significant increase in credit risk. On 15th April, the sales department of the company became aware that the customer is passing through financial crisis and has major cash flow problems. So this is when the sales department became aware. However, if the customer did not pay on the due date, it is reasonable to believe that these financial problems must also be existing as on the balance sheet date. The company has agreed to allow the customer to settle the debt by 31st of March 2014. So I am giving a year more, by which time the customer is confident that the cash flow problem will be resolved. So over here, you are allowing them to pay 60 lakhs, but now you are giving them a full year's time. The company expects that an annual interest of 9%, that is effective interest rate, can be received against any money that is lent out. So that is your actual rate that you could have received, yet it allowed the customer an interest-free period. Why? Because probably there is no other hidden element, but probably you are giving them more time to ensure collection, and hence 60 lakhs to be received after 1 year from 31st March 13 is not the same as 60 lakhs received or receivable today. Determine the amount to be shown as trade receivables from SSLLP in the books on 31st March 13. So the difficulty appears to be existing even on the balance sheet date, and hence your trade receivables will be remeasured. We will say that 60 lakhs is going to be received. Expected cash flow is going to be received after 1 year, and hence 9% to be discounted for 1 year. 1 divided by 1.09, probably 9174. You can even directly divide by 1.09. So 60 lakhs divided by 1.09 can come to approximately 55 lakh 4,587 if I directly divided by 1.09, and hence on the difference between the two, that is 4,95,413, there would be an impairment loss which will be recorded to the profit and loss account. Again, the debtors will appear at around 55 lakh 4,589 on 31st March 13. eventually if asked for the later years, you will record and apply the amortization method for these debtors and slowly move up to 60 lakhs. So this is, I would say, manageable. It is like usually you have this in Ind AS 10 where you have a possible bad debt, etc. that you have to create. For debtor, here you have a possible impairment. That is question number 15. Now 16 is also a slightly interesting case. Over here there are some items of inventory that you are giving as free samples or free items. Like for example, you might have certain products where you buy 3 products of a particular company of HUL. They will give you one of the other product free. That one product that they give free is packaged specifically that this is a product not available for sale. And hence the realizable value over here for this inventory item is technically 0. You cannot really sell it as a company. And hence these inventories should ideally be recorded at 0 balance only. Okay, so let us keep that into consideration and read. B Limited has valued its stock held for distribution as free items on claim by customers on offers at 0. So if there are certain offers and the customer claims legitly under that offer, we have to give this to the customer, and hence for us the NRV for these items is 0, and the company seems to have recorded this at 0, which is absolutely correct. Customers have a right to claim the free item within 14 days from the date of invoice. If the time limit of 14 days exceeds, the claim is foregone by the customer. That's fine. The majority of the free items require online registration by the buyers for participation in the contest conducted by the respective brand, which needs to be done by the buyers within 3 days from the date of the invoice. Okay, so there would be certain online registration, fair enough. Out of it, a few items under this category were found damaged, and the replacement cost of such items would be 2,50,000. So we are giving free items to our customers. Some of the items we have already given, and the customer have said that you are free hai, theek hai, but you have given me a defective product. So on that you will have to incur certain expenses to either replace, repair, whatever it is, and we have been told that the replacement cost of such items that you will have to additionally incur is 2,50,000. So for this, will a provision be created? Well, yes, there is a present obligation because the products have been found to be damaged. Aisa nahi ki our expectation or anything. They have been found to be damaged, and as a result there would be a provision needed for this 2,50,000 separately. Determine whether the entity has to book loss of inventory or provide for replacement cost for goods that need to be given as free items to the customers as per Ind AS. So for the inventory, which is for the free items, it should be shown at nil only. If it is shown at nil, there will be no further loss. But separately, for the items that you will have to incur an additional cost for replacement, you will have to create a 2.5 lakhs provision. So this is the treatment to be done for question number 16. Okay, next is question number 17. It's a very standard and an easy question on cash flow statement, except for 2 adjustments which can make it a little tricky, but other than that it is fairly easy. So you have the balance sheet on 31st March 23 and 31st March 22. Everything is given in lakhs. Remember, if you have just been given the balance sheet and no profit and loss, then you typically follow the indirect method. For direct method, you need data regarding sales, COGS, etc., which is not there. So you'll have to follow the indirect method. You have been given the profit before tax is 200 lakhs. So when you prepare your cash flow from operations, you start with the profit before tax, which is 200. And the provision for tax is 40. Achha, the question does not tell you that it is tax paid. They say it is provision for tax, which is 40. Okay. So institute has solved this in a particular manner. We will discuss what the institute has done and what could alternatively be possible. Institute has assumed that this 40 is not yet paid. So as per ICAI, it is assumed that this 40 is not yet paid, and hence they show this 40 as a part of a provision. 40 is not yet paid. So this will be income tax payable, income tax expense account debit to income tax payable. So you will show a 40 rupees provision or a payable. PP purchased during the year is 100. So this is easy. This will be your cash flow from investing. PP purchased during the year. Current liabilities include, this is the new adjustment. Current liability include capital creditors of 25 lakhs as at 31st March 13, whose balance was nil as on 31st March 12 or 22 and 23 as the case may be. Now what are capital creditors? Capital creditors refer to creditors for buying capital assets. So usually creditors are for goods, and hence its impact is felt in the net profit working. However, if they are capital creditors, they are creditors which are for the purpose of buying fixed assets, and hence they have no connection in calculation of the profit or loss. However, when we say that we are purchasing 100 rupees worth of fixed assets, generally the thought process would be if we have purchased fixed assets worth 100, we must have paid 100. However, if there are capital creditors worth 25 which are still outstanding, that means to buy fixed assets, we have bought fixed assets worth 100, and for those fixed assets 25 worth of payment is still payable, and hence your cash flow from investing would be 100 minus this 25, and this is going to be 75. So this is one adjustment that is to be remembered. Separately, again, when you calculate your current liabilities which are creditors, we will say that these creditors of 45 include 25 of capital creditors which has no connection with cash flow from operations, and hence 455 minus 25, which comes to 430, is your adjusted. Just a second, let me look at the dates properly. Yes, this is your adjusted creditors. There was no opening capital creditors, and 430 minus 450. So this is a reduction of 20. This is a reduction of net 20, and this has to be deducted. A reduction of net 20 is usually deducted. Okay, long-term borrowings raised during the year is 120. So if I look at the long-term borrowings, my borrowings were 300. Ideally on this 120 worth of borrowing. So this is a cash flow from financing. So my answer should be 300 plus 120, that is 420. However, it is 360, which means there must be another 60 of borrowings which are repaid. So there would be a 60 rupees borrowing repaid also considered over here. So this takes care of these items. Now when you look at the balance sheet in general for an understanding, you will see PP. Now PP over here increases by 100. So 410 plus 100, that is 510. And then this has to fall due to depreciation. So 60 will be the depreciation probably. This depreciation will be added back to the profit. So when I look at my profit, maybe my profit is what? 200. On this 200, I will add back 60 because of depreciation. Intangible asset, there is no change. Deferred tax asset, no change. Other non-current assets, there is an increase. Now we have not been told whether this is operating in nature or investing in nature. Institute can assume either of these. So over here, if you assume it to be operating in nature, there is an increase of rupees 10. If you assume that these are due to operating items, then you will take it as a reduction from your cash flow from operation. If you treat it as investing, then this would be a cash outflow from investing activities. Financial assets investment. So this investment is increasing by 40, and hence this 40 will appear as a cash flow from investing, 40 rupees paid. Trade receivables, there is no further adjustment. So over here there is a reduction in trade receivables of 20. Reduction means you will add. Cash and cash equivalent, opening and closing, will appear at 300. Inventories, there appears to be an increase in the inventories by 100. Increase in inventories you will subtract. Other current assets, there is an increase like prepaid expenses, for example, of 40, which we will usually deduct. Equity share capital, there is an increase. This is going to be 30 rupees, a part of cash flow from financing. Other equity, this increases by from 820 to 980. So this is the difference over here is 980 minus 820. This comes to around 160. Now this 160 of difference will possibly be due to 200 minus 40 of income tax, and as a result over here this is probably the difference of 160. There is no further dividend or other adjustment. Borrowings you have taken care of. Other non-current liabilities, again they are increasing by 10. If you assume they are operating in nature, you will add, like gratuity for example, then you will add. Trade payables you have discussed. Bank overdraft is usually going to go into the cash and cash equivalent calculation as a negative item. And there is other current liabilities of 90 and 45. Now what has the institute done over here? If you go to see over here, they have also added 40 rupees separately for the purpose of income tax. Now if you see the solution, just a second, there is 200 less 60 of depreciation as we calculated. Then inventories you directly adjust. Trade receivables we have said 20 add. Non-current assets, as you can see, generally institute always assumes these to be operating in nature. Even non-current liabilities they assume to be operating in nature. That is what the institute usually assumes, and hence you should also do the same. The only adjustment that you should be a little more careful about is regarding trade payables. When you do this, we say that 455 minus 25 capital creditors you accounted separately, and that has gone into this working over here. 100 minus 25, that is equal to 75. When you look at the other current liabilities, we say that your closing current liabilities are, for example, just a second, your closing current liabilities, your opening current liabilities in this case is 90 and your closing liability is in this case 45. So you will make the adjustment for these current liabilities, also consider the effect of tax in that. Other than that, there's nothing much in this question. You have taken all the liabilities. Going forward, they say prepare a statement of cash flows under the indirect method. Even if it was not given, you would have done using the indirect method. Assume bank overdraft is an integral part of the cash management activity. So bank overdraft is not considered to be a cash flow from financing. Rather, it is considered to be a part of cash and cash equivalent in your cash flow statement, irrespective of how it is shown separately in the balance sheet. Okay, again, this is 115 question there in the study material, also there in the RTPs. Over here, you have to figure out what are the separate performance obligations. Remember, they are separate if they are distinct, and if they are distinct, they are not a part of a significant integration exercise, not a part of significant customization or modification practice, or not highly interrelated. So, property sale contract has the common areas. Usually, this is not a distinct obligation. Construction services and building material. Usually, again, this is a part of your entire property purchase agreement. Property management services like maintenance, these are usually distinct. Golf membership is almost certainly definitely distinct. Car parking, it depends. If you have a separate car parking allotment, then it is a separate distinct obligation. In old societies, you don't have that, in which case it may not be distinct. And again, land entitlement depends on whether you are operating in an apartment structure or a bungalow structure. If you are looking at an apartment structure, you do not have any separate rights on the plot of land. The society as a whole has an undivided right. So for you, maybe 1, 2, 3 can be together clubbed as highly interrelated and a part of a single performance obligation in the other 3. Like car parking, again it depends for car parking, but the other 3 like property management services, golf membership, etc. would be a distinct performance obligation. Next is question 19. This is there in consolidation. I think we have done this along with joint venture. There is a stake sale, and then there are certain reserves which are a part which need to be transferred. So at the beginning of the year, we hold 90% stake in BC. During the year, we sell 70%. So that results in a loss of control. Same question, no difference. To PQR was the total consideration of 56. So that is your sale. So bank account debit 56. At the date of disposal, fair value of the 20% interest that is retained is 16 crores, and the net assets of BC are fair valued at 60 crores. So when you pass the stake sale entry, you would record bank account debit. You are receiving, I think, 56 crores for a 90% stake. NCI will also be debited because you will derecognize. Well, NCI will be based on the net assets. If you go to see, your net assets are at 60 crores. NCI will be 10% of that, that is 6. Apart from that, you will also have to recognize the investment, which is at fair value, which is, I think, at 1616 crores. These net assets include the following. So if you go to see, after all of this, there will be a possible balancing figure 56, 6 and 16, and hence there is a balancing figure of 18. This will be taken as a gain on the profit and loss. Acha. Now the net assets included the following. They included the following: debt investments classified as FVOCI of 12 crores and related FVOCI reserve of 6. So when I derecognize the net assets of 60 crores, along with that, your investment in debt is also removed, and hence you don't have to separately record that. However, the 6 crores, which is an FVOCI reserve, will have to be reclassified. It is a part of reclassifiable OCI. But how much of that? Well, 6 crores is the entire. 90% of it will be my share, 10% will be attributed to NCI. When NCI is debited, we have already derecognized the part attributed to NCI, and hence your entry will be fair value reserve or 5.4 to, let us say, statement of profit and loss 5.4, because it is reclassifiable OCI. Defined benefit obligation of 6 crores that has resulted in a remeasurement reserve of 3 crore. This is a loss. Again, 90% of that is going to be 2.7, and hence you will have to derecognize this. So you will have to remeasurement reserve. You will have to derecognize your share, which is 2.7, and the corresponding debit will go to the retained earnings because it is a part of a non-reclassifiable OCI under Ind AS 19. Equity investment not held for trading of 10 crores, which are derecognized along with the net assets, which irrevocable option of recognizing them to FVOCI has been availed at 4 crores. 4 into 90%, that is equal to 3.6 our share. Again a non-reclassifiable OCI, and hence fair value reserve account debit to, let us say, retained earnings would be 3.6 over here. And lastly, net assets of foreign operation of 20 crores, and FCTR is 8. So your share is 8 into 90%, that is 7.2, and FCTR is a part of a reclassifiable OCI, and hence you will transfer it to the PNL. So this is a question where you will be tested on your understanding of reclassifiable as well as non-reclassifiable OCI, your understanding of a stake sale, and this is kind of a repeat question again. So the question asks you, in the consolidated statements of AB, 90% of the above reserves were included in the equivalent equity balances and 10% is attributable to NCI. They have told you this. Even if this was not told, we would have still assumed that only 90% are attributable to, let us say, the group, 10% is attributable to the NCI. What would be the accounting treatment on the loss of control in the CFS? So over here, there is probably going to be a gain of around there would be a gain of, I think, 18, and then every other reserve you see 5.4, 2.7, 3.6 and 7.2, and that is about it. The last question over here is on share based payment for other than employees. In case of other than employees, that is for goods and services, you will have a grant date, you will have the measurement date. Grant date is a date when agreement is entered into. Measurement date of fair value happens on the date when the risk and reward is actually transferred. That is usually the date when delivery is given, control is transferred. Again, the fair value is based on first the fair value of the goods and services, and if the fair value of the goods and services are not available, then you take the fair value of the shares. So keeping that into consideration, the last question for this RTP, question 20. Fashion India Limited entered into an agreement with RFD on 10th of August for purchasing a machinery. The agreement has a clause that FIL will have to settle the consideration of the machinery by issuing its equity shares. FIL agreed to this clause and the order was confirmed. Okay, so over here we have entered into an agreement on 10th of August. This will be like your grant date as per Ind AS 102 for other than employees for purchasing a machinery. Sir, why is 102 applicable? Because FIL agreed to issue and settle by issuing own shares. So this is to be a share based payment. Machinery was supplied by invoice dated 25th October and delivered on 1st November. So 1st November is the date when the risk and reward incidental to the machinery is transferred, and hence the measurement date ideally for recognizing the machinery, the measurement date would be based on the fair value of the machinery on 1st November. Agreed purchase consideration was 150 lakhs and the fair value of the machinery supplied was 160 lakhs. As agreed, FIL supplied 1 lakh equity shares of the face value 100 each to RFD. Now, at what value will you measure this? We will measure it at the fair value of the machinery received. Sir, a lot of times we say it's a barter, and if it is a barter, we will recognize the machinery at the fair value of the assets given up. Yes, if it is a regular barter, but if it is a barter involving entity having to issue its own shares, then 102 will override Ind AS 16, and as per 102, you will measure the machinery at the fair value of the machinery received, not based on the fair value of own shares given. As per 102, what should be the price and the date of recording the transaction? Date would be 1st November and the price would be 160 lakhs. If you go to see, your entry would be on 1st November, machinery account debit, let us say 160, to equity share capital, that is 1 lakh in the face value of 100, and hence the remaining 60 will go to the securities premium. Now one might argue that ideally the balancing figure over here is taken as 60, however it should be 50 because the agreed price is 150. Does not really matter. As per Ind AS 102, you will measure goods and services at the fair value of those goods and services, and hence we will measure this at 160, and hence the balancing figure for the shares in the securities premium will be 60 rupees. So that takes care of the RTP for May 24. I hope this video has been helpful to you. If yes, please do like, share and subscribe. I will see you soon with another video. Till then, keep studying. I'll see you. Bye bye. Take care and work hard.